Hey everyone, and welcome back to the show. So, if you're new to this channel, welcome. And for those who have been around for a while, welcome again, congratulations on being here again. So, there's a lot that has been happening in the stock market for this year. So, it actually has turned out the opposite to what many persons actually had thought and hoped initially. So investors, stakeholders, all those. So persons were expecting that this year 2025 would actually have picked up off the back of 2024 in terms of starting with a good bang, with a good punch, and just dominating the international markets, dominating the world with the stock trading, the values, just everything. But it turns out that everything is actually the opposite. So everything that investors and persons who have a genuine interest in the stock market had hoped for is actually the opposite, which leads to us to the question, what really is happening in the stock market? So to answer this question, you really have to go back to 2024 and look at what happened during 2024. So, during 2024, the stock market actually had performed at one of the best that it had in a 12-month period. So, the S&P 500 was up about 24%, while the NASDAQ was up about 34%. And given everything that had happened throughout 2024, the market really shouldn't have been doing as well as it did. So interest rates were actually at one of the highest it has been recently. Interest rates actually didn't get cut until about the last quarter of 2024. Inflation was actually at one of the highest levels it has been also. So inflation was actually being cut from about 2020 to 2023 thereabout. And so what happened was that the Fed was really tracking and managing inflation and interest rates. And so on top of that, jobs reports were actually down as well too. And so all of these were really negative in terms of how the stock market should be performing. Investor confidence was also low as well too. So the markets were more fearful. And then fast forward throughout 2024, the US elections came and the market was very choppy during that period. And by choppy, I mean that 1 minute was high, 1 minute it was low, and it just kept going up and down like that. Then the election results came out, and President Trump was announced the winner, and the markets immediately rallied for about 2-3 days. And then it kind of flattened out, and then it started plateauing again, and then it picked up towards the end of the year. So what does this really have to do? So for 2025, the markets actually had picked up for about 2 days. So the 2nd and the 6th of January 2025, the market actually had increased. And then it started on a downward trend. And it was declining for about 2 weeks. So by Thursday, January 16th, the market actually had picked up. So around Wednesday, Thursday, the market picked up. And then, so the market was actually downward from the 6th. And it really picked up Wednesday, Thursday. That's when the market really had picked up. And so the NASDAQ and the S&P 500 indexes are currently at 1.81 and 2% for the year-to-date so far. And interestingly, the S&P is actually outperforming the NASDAQ Index, which is actually very interesting because usually the NASDAQ outperforms the S&P 500. Now, to really understand what's happening in the markets, there has been large movements from the tech stocks and the AI stocks. So these are heavily what the NASDAQ Index is comprised of. So stocks like Apple, Nvidia, Microsoft, those sorts of tech companies, AI focused companies would be in the NASDAQ. And so up until before Wednesday, so about Monday, Tuesday of the 14th, 15th, the markets were actually downward, and it was just on a constant decline, looked like a never ending decline. And it finally picked up and recovered now. But before, the market was really down. And so this would have influenced or affected the actual NASDAQ and the whole tech and AI space. So this really had drawn down the price, and it really boils down to investor confidence right now. And so if you look at the CNN's Fear and Greed Index right now, it's the number assigned is actually 36, which suggests that investors are very fearful as to what's happening in the markets right now. They are very uncertain, they're unsecure, unsure of exactly what is happening and what is gonna be happening as well. So if you look at the VIX as well, so the VIX is really just a CBOE index gauge, so it really just tracks the futures and options market. So it's really Chicago Board Exchange. So this number has actually been declining since January started. So it was at about 18.26 at the beginning of the year, and now it's actually down to about 15.97 points. And so what this really is suggesting to us is that the investor confidence is growing. So if you tie back to the Fear and Greed Index as well, the investor confidence is slightly good. So the Fear and Greed Index was actually about 26 points the prior week. I know it's at 36, so it raised about 10 points. The VIX is down about 3 points since the year to date. So this really is suggesting that the investor confidence is growing as well. And so you might be wondering why the sudden change in the confidence of the investor. Well, there was a jobs report that came out about 2 weeks ago. And so the jobs report actually indicated that a lot new jobs were actually taken up. And so the number of persons in the working force had actually increased and far outweighed investor predictions and estimations. And so because of this would have actually been good news for investors. The other thing to note, or the other point to note, is that President Trump officially takes office tomorrow. So the entire first 2-3 weeks of January was actually still under the Biden administration, and so the policies would not have officially been handed over. And so with the new head entering into the White House, then investors are a little bit more confident, and based on what's happening with the indexes, it still suggests that they are still very fearful, and so they really are operating with caution right now. Now, to give some more insights, so we earlier in the video had said that investors were moving out of tech companies. So Apple was down, Microsoft was down, Nvidia was down, AMD was down, Intel was down. All these heavily front running stocks that did well for 2024 were down. And interestingly, the money actually had shifted into the banking sector. So JP Morgan is actually up Amex is up, Bank of America is up. So the funds had moved from the very speculative, very high driven intensity tech stocks into the more economic building, economic growth types of stocks, which are somewhat more volatile as well due to the leverage and risk that these companies take on. But traditionally, they normally do well during good economic times, which, as the markets would suggest, investors, even though the fear is still there in the market, the confidence is somewhat building, and persons are a little bit more optimistic as to what's happening. So we had actually done a video at the beginning of 2025 where we shared the top 3 industries that we believe would do well for 2025, and in that we actually had spoken about the banking industry, and we shared that the banking industry would actually be one of the industries that we believe will do well for 2023. And the reason why we had stated that was, so I'll just give you the highlights so you can, I'll link the video down below so you can actually watch to get the full story. But what we had actually suggested, the main point that we suggested was that as long as inflation remains below 3%, it currently is at 2.7%, then the banking industry is actually going to increase for 2025. We believe it's going to increase. And this is because interest rates have started lowering. It's not a significant lowering because it's us down 25 basis point, but that's a start. And usually what you want is that when interest rates start lowering, then the commercial banks eventually will start lowering their interest rates. And so when the commercial banks start lowering their interest rates, more persons will actually be inclined to start borrowing again. And so if more persons with interest rates lower than it would be 6 months, 12 months, 2 years ago, then more persons are going to start borrowing. And then if with the jobs report showing that more persons, 256,000 new jobs were actually created. So with more persons in the working world and interest rates started lowering and should or is expected to be lowered again throughout the year, and inflation is below 3%, then the economy really is going to start being stimulated again, because persons are going to have that security and they're going to be able to actually afford mortgages, personal loans, motor vehicle loans, all these different types of things. And so that will really stimulate the economy. And right now, the Dow Jones US Banking Index is at about 7.5% right now, which is in line with what we had predicted at the start of the year. So as the time goes by, as long as inflation, that is the most or one of the most important metrics that we're using to measure this index as well and this industry. So as long as inflation remains below 3%, then the banking industry should continue growing for 2025. If it touches that 3% or goes over it, then you can expect a decline or a slowdown in the banking industry. And this will be because the Fed would have to change their policies to actually get the inflation rate back down to below 3%, because right now the target is 2%. So they're still not in the clear. But it's a lot better than where they were 12 months ago, 24 months ago. So as long as inflation is below 3% and with interest rates scheduled to are expected to actually start declining again throughout the year, No, we're not sure when again the next rate cut will be, but whenever it does happen, then the commercial banks will eventually lower their rates, and once the mortgages, motor vehicle, personal loan rates have started reducing, more persons are going to actually start taking out loans, which will stimulate the economy and also boost the revenues of these commercial banks. Now, heading the banking index would be JP Morgan, which is actually up about 7.8% from year to date. And this was so because during the quarterly financials, so the first quarter, the results that actually came out about in that January period. So there are a few companies that came out and a few more set to actually be coming out towards the latter part of January. JP Morgan was actually one of the very few companies that recorded great profits, and so with the profits being recorded and revenues increasing, persons had shifted their funds from the tech industry, the AI in space, into the banking industry. Amex also is up about 4%. So this is good news for the banking industry. So it hasn't been 1 month as yet, and the industry is averaging about 7.5% based on the index, which is great news for us because it's in line with our predictions. And so with that being said, is now the right time to sell AI stocks? And my answer to that is no. So long story is that the stock market tend to move in waves. So 1 minute the market will be up, another minute it will be down. 2024, the AI space, the AI industry was doing really well. Right now, it hasn't been a month since the new year started, and it's just really investor confidence that really caused the decline in the AI stocks, in the technology stocks. But as the year progresses, so within the next 3, 6, 9 months, we do believe that the AI space will be seeing more growth, and Nvidia will be leading it because Nvidia right now is leading chip makers for artificial intelligence. They are one of the key makers for gaming chips as well too, and so we believe that as the year progresses, Nvidia and other artificial intelligence companies will also start increasing as well too. And as we had shared in the 3 key takeaways video, that artificial intelligence we believe is going to be doing well for 2025, 2026, but in the future, and we're really not sure when in the future, it could be 2027, it could be 2030, but we do believe that eventually in the future the whole AI space will be less saturated, and it really will become like a survival of the fittest. So only the best of the best companies will actually remain there, and the other companies that were just really riding that AI wave will either be merged with a larger company that would actually have found value in them, or they just have dwindled down and closed down altogether. So essentially, we believe that the AI bubble will start bursting in the next few years, possibly 2, could be 5 years from now. Really, I'm not able to say when, but we do believe that something very similar to the dot-com crash would happen with artificial intelligence as well too, because it's very similar and close proximities and exhibitions of behavior that is happening right now as what had happened back in the 90s and early 2000s. So we believe that there's going to be very close and similar behaviors that to be expected. So right now with the markets and the jobs report that just came out, now we investors really are just looking towards inflation and the inflation data that should be coming out for December, and looking forward to that. Interest rates, we're really waiting and seeing when interest rates will be cut again, if it will be cut again, and when. So there's no telling at this point when it will be. And with President Trump finally taking office tomorrow, we're really just in a wait and see to as to what policies he really starts implementing at the get-go, and what he does over time, and how it really benefits companies, traders, stock holders, stock traders, and really the wider community. And so there's a lot that has happened in the United States so far in the stock market. There's a lot to happen, and there's a lot that will happen. So continue tuning in, continue staying in the news. If you need additional information, check out Bloomberg and CNBC, and Reuters actually has a very good morning roundup that they send out to persons in their inboxes every morning, and it just gives you a highlight of what is to be expected for the day. And so that's really good. And you can also just read different articles, different news articles, subscribe to different magazines as to really get what is happening in the markets, because in reality the person with the most knowledge has the least risk, because they would have reduced the amount or the unexpected variables to as much as their level of knowledge is. So the more that you know is, the better it is for you, because you know exactly what to expect, you know exactly what to look out for, and you know exactly what to do. So on that note, thank you guys so much for tuning into this episode. I hope that you liked it. If you did, feel free to give us a thumbs up or a heart. Leave any comments down below. Get in touch with me at mytcapital@gmail.com if you have any further questions that you might be a little bit shy in asking in the comments. You can reach out to me via email. Share this video with a friend, family member, a loved one. Have that discussion. And you can also reach out to me in the comments as well, so we can have that discussion as well and really educate everyone. And until next time, take care. Love you guys. Bye.